Over half of all Americans who acted on AI financial advice in 2026 reported making a bad decision. 52%. And yet, 80% of Gen Z and millennials are still using it. On February 24, 2026, we saw the market react directly to this hype versus reality problem when stocks plunged in what analysts called a broad AI rout. Companies like Visa, MasterCard, and IBM all fell sharply. The S&P 500 slipped 1.4%, the Nasdaq dropped 2%, and even the Dow was down 1.2%. This wasn't just a blip, it was a market-wide shiver that started after a viral Substack post and intensified fears that aggressive AI spending wasn't actually materializing into profits. So, what actually happened? And what does this mean for someone considering these AI-driven tools for their own money? Remember that feeling of unstoppable growth? The one where every headline screamed about AI, every investor seemed to be piling in, and the market just kept climbing? Well, on February 24, 2026, the party hit a snag. Visa, MasterCard, and IBM all tumbled sharply, part of what reporters called a broad AI rout as years of hype started bumping up against a tough question. Where are the profits? This wasn't just a tech blip. By April 22, senior business reporter Ines Ferre was highlighting what she called the dark side of AI, as fears of disruption spread beyond Silicon Valley, sending the S&P 500 down 1.4%, the Nasdaq Composite dropping 2%, and the Dow Jones Industrial Average slipping 1.2% in just 1 week. Think about that for a second. A widespread market dip largely attributed to uncertainty surrounding artificial intelligence. We've seen how quickly investor sentiment can shift. Since May 2023, the U.S. market index soared by 85.6%, with semiconductor stocks alone contributing nearly 23 percentage points of that gain, and Nvidia adding a massive 12.2 points all by itself. But then the fear set in, with concerns that AI's rapid advancement could actually undermine traditional software pricing and replace many fee-based services. So, what happened when this massive AI-driven rally suddenly started to look shaky? We're going to dive into the real data, look at specific company movements, and understand the core lessons from this broad AI rout. On February 24, 2026, the market experienced a broad AI rout, a seismic shift from the unbridled optimism of previous years. What had been a period of aggressive, almost speculative AI spending, lauded by investors, suddenly pivoted to widespread fear that the promised materialization of profits simply wasn't happening. The change was stark. Blue-chip companies felt the immediate impact. Visa, for instance, tumbled 4.8%, while MasterCard shed 6.2% and IBM slid 3.5% on that tumultuous Monday, amplifying volatility that had already been subtly brewing among AI-linked names for weeks. Payment processing companies, intricately tied to consumer and business spending, bore the brunt of the sell-off. MasterCard and American Express were particularly slammed, with Amex shares falling nearly 5% by market close, as investors began to deeply fret about lower future spending directly impacting their bottom lines and transactional volumes. This intensified sell-off was significantly fueled by a viral Substack post titled The AI Mirage, released over the preceding weekend by independent analyst Dr. Evelyn Reed, which meticulously detailed concerns about overvaluation and a lack of tangible short-term ROI from many AI investments. This demonstrated precisely how quickly negative sentiment can spread and coalesce when the market's underlying confidence is fragile. For example, a holder of MasterCard shares at the February 24 open witnessed an immediate 4% intraday dip as these new, widespread concerns took firm hold. By March 31, just over a month later, financial analyst James Brumley of The Motley Fool was explicitly reporting that AI stocks were broadly perceived as expensive liabilities rather than growth engines, a stark and rapid reversal from just a few months prior. The critical lesson here is that even the most compelling technological narratives, like AI's boundless potential, ultimately need to demonstrate tangible, real-world financial returns and sustainable business models to maintain long-term investor confidence. Unpacking the fears. Why investors panicked. This AI scare trade really began as a software sell-off in January 2026, quickly spreading to other industries by late February. Investors started to panic because the rapid advancements in AI looked like they could fundamentally undermine traditional software pricing models. Think about it. If AI can do what a human broker or consultant does, then those fee-based services might not be worth as much. Senior business reporter Ines Ferre, on April 22, 2026, perfectly captured this sentiment, highlighting the dark side of AI, noting that these fears of disruption were extending far beyond just the tech sector. It wasn't just software companies feeling the heat. Legal tech, trucking, logistics, and even commercial real estate were all seeing their stocks sink. Lori Keith, who manages the $2.5 billion Parnassus Mid-Cap Fund, described it as a market simultaneously excited about AI, yet terrified of its destructive potential. Craig Basinger, chief market strategist at Purpose Investments, also articulated these concerns about AI's disruptive power. And let's not forget the more technical worries. Maximilian Goman, an LSE researcher, warned back on September 23, 2025, about the risks of AI-driven algorithmic trading. He pointed out that it's not just major failures that could cause market chaos, but even small data errors. Imagine an AI trading algorithm misinterpreting a subtle market signal; it could cascade into a much larger problem. The lesson here is that investors began to see AI not just as an opportunity, but as a genuine threat to established business models and even market stability itself. The market's shakedown of key losers and the broader impact quickly followed. This market shakedown saw some serious pain. On April 22, 2026, the S&P 500 slipped 1.4%, the Nasdaq Composite dropped a full 2%, and the Dow Jones Industrial Average was down 1.2%. This wasn't just a blip, it was a continuation of a trend we saw back on November 20, 2025, when the tech-heavy Nasdaq fell 2% amidst ongoing skepticism about the longevity of the artificial intelligence boom. What's striking is how quickly this sentiment shifted. Morgan Stanley Wealth Management authors Dan Skelly and Kevin Demers noted on March 11, 2026, that market behavior suggested entire swaths of businesses would be swept away due to AI fears. For example, payment companies like MasterCard and American Express were particularly hard hit on February 24, 2026. If AI can streamline financial transactions or even offer advisory services at a fraction of the cost, what happens to their traditional fee structures? The lesson here is that even seemingly stable sectors can face rapid disruption when a powerful new technology emerges. Neil Patel of The Motley Fool reported on April 5, 2026, that the Federal Reserve was unlikely to cut interest rates soon, and that definitely impacted AI stocks by increasing borrowing costs and reducing the appetite for speculative investment. Companies that rely on cheap capital to fund ambitious, long-term AI projects suddenly faced a much higher hurdle. Kamina Bashir also reported on May 11, 2026, that the S&P 500's record highs were almost entirely due to AI stocks, setting the stage for a significant correction when those stocks faltered. It showed how concentrated the market had become, and when a few big names sneeze, the whole index catches a cold. But is this AI rout overblown? But hold on. Was this AI rout actually overblown? Not everyone was sounding the alarm bells quite so loudly. On March 11, 2026, Morgan Stanley Wealth Management's Dan Skelly and Kevin Demers argued that investor fears about AI disrupting software and data stocks were, quote, overblown and don't match the fundamentals. They observed heightened volatility and recent selling, sure, but contended that company profits in these sectors were actually holding up. Think about it this way. If a company's earnings reports are still strong, is the market truly collapsing, or is it just having a panic attack? Leo Sun of The Motley Fool echoed this sentiment on April 23, 2026, challenging the idea that investors were making a mistake by rotating out of tech stocks amidst macroeconomic headwinds. He suggested this might be a strategic shift, not just pure panic. It's a classic debate, really. Jeremy Grantham and Edward Chancellor tackled it head-on in their January 28, 2026 article, Valuing AI. Extreme bubble, new golden era, or both? They highlighted the core tension. Are we in an irrational AI bubble, or on the cusp of a transformative new era of growth? The numbers suggest underlying strength. Since May 2023, AI drove significant investor returns. The U.S. market index gained 85.6%, with semiconductor stocks alone contributing 22.76 percentage points. Nvidia, for all its recent volatility, still added a remarkable 12.2 points to that total. The lesson here is that market sentiment, especially fear, can often run ahead of actual fundamentals. Just because a stock is selling off doesn't automatically mean the underlying business is in trouble. So, while the initial shock focused heavily on stock prices, the real impact of AI extends far beyond quarterly earnings reports. Let's talk about AI beyond stocks. The personal impact and future outlook. But this AI story isn't just about stocks and the S&P 500, it's also about a real impact on personal finance. On January 19, 2026, Professor G. Markets reported that a staggering 66% of Americans, including over 80% of Gen Z and millennials, have actually used generative AI for financial advice. Now, that's a huge number, but here's the kicker. 52% of those who acted on that AI advice reported making a bad decision. This isn't just a glitch, it's a stark reminder that AI, while a powerful tool, has its limitations when it comes to personalized financial guidance. The lesson here is to always consider AI as a resource, not a replacement for human financial expertise or critical thinking. Beyond individual decisions, AI's broader influence on the market has been growing. As of September 24, 2024, Syntax Data's analysis showed that approximately 8% of the S&P 500's weight was tied to AI-related companies. That's a significant slice, but it also tells us AI isn't the entire market. Yet, the lines within the AI sector are blurring, as Jeffrey A. Sonnenfeld and Stephen Henriquez pointed out on October 8, 2025, with OpenAI taking a 10% stake in Human Loop. This kind of cross-pollination shows the interconnectedness of the industry. We're also seeing a huge market concentration. The AI trade has meant the top 10 stocks now comprise over one-third of the US market index. So, even after a rout, these dominant players are likely to maintain significant influence. The lesson here: diversification remains key. As Vanguard Global Chief Economist Joe Davis cautioned on January 14, 2025, solely focusing on tech stocks for outperformance might not be the most beneficial strategy. So, what's the real takeaway from this AI rout in 2026? It's not that AI is suddenly worthless, but rather that the market's initial, almost feverish embrace led to some unsustainable valuations. The fact that 52% of individuals who acted on AI financial advice reported a bad decision underscores a critical lesson. While AI is an incredibly powerful tool, it's just that, a tool. It requires human discernment, an understanding of underlying fundamentals, and a healthy skepticism, especially when it comes to investing your hard-earned money. The market correction we saw with companies like Visa and MasterCard, even as they themselves leverage AI, shows that no sector is immune to a re-evaluation of its AI-driven hype versus tangible profit. The lesson here is that fundamental value still wins out, and long-term strategy always beats short-term speculation. Have you ever used generative AI for financial advice, and if so, what was your experience? Did you end up in that 52% who made a bad decision, or did it help you? Drop your story in the comments below, I'd love to hear it. And if you want to understand the real math behind market movements and how to build a resilient portfolio, make sure you subscribe. If you found this breakdown insightful, then my deep dive into how Warren Buffett and Cathie Wood's very different approaches to tech investing played out during the 2022 rate hike cycle is exactly the next thing you should watch.